students. Today I want us to revise a question, ATD Financial Accounting, May 2019, question 2. ATD Financial Accounting, May 2019, question 2. This is a question of accounting for partnership. The question reads, John and Ken are in partnership sharing profits and losses equally. So that gives you the profit sharing ratio. That's 50-50. The following list of balances were extracted from their books of accounts as that 1st of December 2018. Freehold property at cost, motor vehicle equipment at cost, accumulated depreciation, accounts receivable, accounts payable, bank balance, carriage outwards, salaries and wages, purchases, inventory, opening inventory, that is, return inwards, cash drawings, current account, and capital account. Then you are told additional information. So we start with the workings. We start with workings based on the additional information. And we are told, number one, salaries and wages outstanding were 200,000. So they were salaries and wages. We are told there were salaries and wages which had not been paid. From the trial balance, our salaries and wages were 8840. So if we say balance brought down 8840, we told that salaries and wages amounting to 200,000 had not been paid. And therefore, we add 200,000 because this is an expense which has been incurred but not paid. So salaries and wages payable. We have salaries and wages payable amounting to 200,000. 200,000 from salaries and wages. From salaries and wages account. So salaries and wages payable. So total amounts to 9040. Total amounts to 9040. And this is a current liability. Salaries and wages payable becomes a current liability, and our salaries and wages expenses become 9040. Then we are told carriage outwards paid in advance as the 31st of December 2018 amount to 160,000. If you look to a trial balance, our carriage outwards, we know that our carriage outwards is usually an expense. So balance brought down from the trial balance, balance per trial balance of carriage outwards is 5560. It is 5560. And we are told, although we paid 5560, we have not spent the whole of 5560. We have a balance carried down of 160. A balance carried down of 160, which is an asset, is a prepaid carriage outward. It's a prepaid carriage outwards, 5560. This one, therefore, we take to P&L. We take to P&L account, 160, it's 5400. 5400, we take it to P&L account as the carriage outwards expense. Our carriage outward expense will be 5400, and our prepaid carriage outwards 160 will be a current asset. Then we are told the partnership agreement provides the following: interest to be allowed on fixed capital 10%. John is entitled to an annual salary of 2.4 million. Interest to be paid, to be charged on cash drawings at the rate of 10%. Interest on cash drawings. It is 10%. We know cash drawings, what is really said there? 10%. 10%. So for John and for Ken. For John, the cash drawings for John, so we told this the interest on cash drawings, it is 10% for all of them. 10%. So you get the cash drawing for each one of them. For John it is 4,000, for Ken is 2,000. 4,000, and this is 2,000. This gives us 400, and this one gives us 200. 400 and 200. Then we are told sales per month amounted to 8150. So if sales per month, is equal to 8150. If 1 month is 8150 and the year has 12 months, we multiply by 12. We multiply by 12, 8150 times 12, our sales become 8150 times 12, our sales become 97,800. 97,800. Our sales become 97,800. 9150 times 12. Our sales become 97,800. Then we are told inventory, the closing inventory is 10,000. Number 6, we are told during the year, the partners took inventory amounting to 2,400 and 1,600 for John and Ken respectively. We know that drawing of inventory reduces purchases. Drawing of inventories reduces purchases and increases drawings. It reduces purchases and increases drawings. Now, if we get our purchases account, the balance brought down of our purchases is 66,600. Is 66,600. It is 66,600, and the drawings are drawings for Peter. So for Ken and John, Ken is 2,400, John is 1,400. You add the 2, you get 4,000. You subtract from purchases 4,000. You subtract from purchases. Never forget that when the partners withdraw inventory, anytime we withdraw inventory and use it for personal use, we debit drawings and we credit purchases. We do not credit inventory because we do not maintain the inventory account in the books of accounts. We credit purchases. We reduce purchases. Giving us the correct balance for purchases. As you subtract 4, it gets to 4,000. You get 62,600. 62,600. 62,600. So the correct purchases figure is 62,600. It is 62,600. It is 62,600. Then we are told depreciation is to be provided as follows. So if we were to get the depreciation expenses, we are told motor vehicle, it is 25%, and the one for equipment, it is 20%. It is 20%. Now, those rates, if you multiply the original purchase cost for motor vehicle is 8,000. Is 8,000. It is 8,000. We get 2,000. That is the straight line method. But equipment, we are supposed to use reducing balance method. Reduced balance method. So we get the reduced balance of the equipment, the value of the net book value of the equipment at the beginning of the year. The net book value of the equipment at the beginning of the year is the original purchase cost. You subtract the accumulated depreciation. The original purchase cost for the equipment is 6,000. And then you subtract accumulated depreciation at the beginning of the year for the equipment, which is 1,200. 1,200. We get 6,000. 123 minus 1,200. We get 4,800. Then you multiply that by 20%. By 20%, you get 960. You get 960. You get 960, and those are the adjustments that were required. Those are the adjustments that were required. So we prepare our income statement. We prepare our income statement and the balance sheet. We are required to prepare 3 things. We are required to prepare 3 things. Income statement gives us 10 marks. Partners current account 4 marks, and the statement of financial position 6 marks. So we say John and Ken. Income statement. You could call it partnership. John and Ken partnership. Income statement. For the year ended December 2018. Year ended 1st of December 2018. We said our sales, we got our sales here, we said it's 97,800. We said our sales is 97,800. These are figures which are shillings in thousands. These are shillings in thousands. So when we say 97,800, we mean 97,800,000. So we say our sales, check. Please always remember, you're supposed to have the format of the income statement in the head so that you can always keep checking whether those items are in the trial balance. So we say let's return inwards in our format. So we check if there is any return inwards, and for sure it is there. Return inwards of 1,600. So we say let's return inwards. Let's return inwards of 1,600. 1,600, 97,800 minus 1,600, 600, we get a figure of 96,200. We get a figure of 96,200. Then we say that is called net sales. That is net sales. Then we say less. We say less expenses. Less expenses. Less expenses. My recommendation. Always start with the expenses which we had adjusted. Always start with the expenses which we did adjustments. So salaries is 90/40. Salaries it is 90/40. Salaries it is 90/40. And then carriage outwards 54. Remember we said carriage outwards is an expense. Carriage outwards is an expense. 5,400. 5,400. 5,400. Then depreciation. Depreciation, we have 2,000 motor vehicle, 2,000 equipment, 960. Once you are through with the expenses that required your adjustments, where you did adjustments, you now go back to the trial balance and check whether there are any outstanding expenses. Check whether there are any outstanding expenses. After getting net sales, 96,200, we say less cost of goods sold. Less cost of goods sold. Less cost of goods sold. And we start with, always in our format, the format must be in the head, opening stock. You know, we start with opening stock, and the opening stock is given there as 8,000. The opening stock is given there as 8,000. We add purchases. Remember our format in the head. We add purchases, and we said we have adjusted our purchases. So our purchases is 62,600. 62,600. Then check whether we have something called carriage inwards. Check whether we have something called carriage inwards, and we do not seem to have anything like carriage inwards. We don't seem to have anything like carriage inwards. So if we add that with 0.068, 10, 70, 8,000 plus 62, 8,000 plus 62, 600, we get 7,600. We get 7,600. This is cost of goods available for sale. Cost of goods available. Those are the cost of goods available for sale. 7,600. We say less closing stock. Additional information number 5 gives us the closing stock as 10,000. Giving us the cost of goods sold amounting to 6,600. Our cost of goods sold becomes 6,600. So if we say 66, we say the net sales 96,200 minus the cost of goods sold 6,600, we get 35,600. That becomes our gross profit. 35,600 becomes our gross profit. It becomes our gross what?
Profit.
Our gross profit. It becomes our gross profit. And always remember our format. Remember our format in the head. Remember our format in the head. You're supposed to have asked yourself, add other incomes. Check whether we have other incomes there. And fortunately, we do not have anything like other incomes. So we say less expenses, less expenses, less expenses, less expenses. And like I said, you always start with the expenses we had adjusted. Start with the expenses we adjusted. Once you are through with the expenses you adjusted, check in the trial balance whether they are expenses which we incurred, yes, we paid for, and therefore there was no adjustment. There was no adjustment. So our salaries and wages is 90/40. Salaries and wages was 90/40. 90/40. Our carriage outwards, remember, is 5,400, not 5,560. So carriage, and always remember, carriage inwards is part of inventory. It's part of the cost of inventory, but carriage outwards is an expense. Carriage outwards is an expense. We said that carriage inwards is the cost of transporting inventory to the business, but the cost of transporting inventory from the business to the customer is carriage outwards, and it's an operating expense. It is an operating expense. It's an operating expenses. Then we go to depreciation. We go to depreciation, and we start with the motor vehicle. Motor vehicle depreciation, and we said it is 2,000s. We said it is 2,000s. Then we have equipment depreciation, and we said it is 960. It is 960. Those are the expenses which we adjusted. Then go back to the trial balance and find out if there are any expenses which we incurred, we paid, but we never adjusted. You go through purchases, return, return, cash flow. I'm not seeing any. Let's try to add these ones up and see how we move on. 90/40 plus 5,400 plus 2,960, 2,960, we get a figure of 17,400. Our expenses become 17,400. Total expenses. Total expenses become 17,400. If you subtract from our gross profit 35,600, we get profit for the year amounting to 18,200. We get profit for the year. Profit for the year is 18,200. Profit for the year is 18 what? 18 what?
200.
18,200. Then we talked about interest on drawings. Additional information number 3. We are told interest shall be charged on drawings at the rate of 10 cash drawings, and it is here, at the rate of 10%. And we said that interest on drawings is an income to the firm. Interest on drawings is an income to the firm because it is when the partners overdraw their accounts and the firm charges them interest because of the overdrawn drawings, then that interest becomes an income to the firm. So you add it to the profit for the year to get the aggregate profit. So we say add interest on drawing. Add interest on drawings. Add interest on drawings. And we are saying John is 400. John, it is 400, and Ken, it is 200, giving us a figure of 18,800. This is aggregate income to be distributed. This is aggregate income to be distributed among the partners. That is the aggregate income to be distributed among the partners. Then we start the appropriation. We start the distribution among the partners. We are told interest to be allowed on fixed capital at 10%. So we say less interest on capital. Less interest on capital. Less interest on capital. Less interest on capital. Less interest on capital, and the rate is 10%. John and Ken. 10%, 10%. Interest on capital is the rate of 10%. If you get John's capital is 24 and 18. John's capital is 24,000 and Ken's capital is 18,000. So if you get all of them, John's capital becomes 2,400 and this one is 1,800. If you subtract the two, 18,200 subtract 2,400, subtract 1,800, you get a figure of 14,000. Get a figure of 14,000. Get a figure of 14,000. 18,800 minus 2,400 minus 1,800. We get a figure of 14,000. So we get a figure of 14,600. We get a figure of 14,600. Then we are told John is entitled to an annual salary of 2,400. John, so less salaries. Now John is entitled to a salary of 2,400. We say less salaries. John was entitled to salaries of 2.4 and Ken had nothing. So we subtract 2,400 from 14,600. We get 0, 0, 6 minus 4, we get 2. 4 minus 2, we get 2. We say 12. Now that is the profit after deducting interest on capital and salaries, so that we now share to the partners. Based on the profit and loss sharing ratios. We are told at the beginning that they share profit and losses equally. Profit share. John gets so this is divided by 2, 6,100, and Ken gets 6,100. So we get 12,200. We have a balance of 0. That's the income statement is supposed to do, and that is what was supposed to give you 10 marks. So remember, this is the information that we put into the partner's current account. That is the information we put to the partner's current account. Let us prepare the partner's current account. And we say partner's current account. Partner's current account. So we get the partners, and we're saying the two partners are John and Ken. They are John and Ken. Their balance brought down from the trial balance for the partner's current account. For John is 8,000 and Ken is 6,000. 8,000 and 6,000. 8,000 and 6,000. 8,000 and 6,000. 8,000 and 6,000. So we now pass the information. We pass the information there. We get our information there. So interest on borrowings is an expense. It reduces the claim. interest on drawings. Interest on drawings is an expense. So John gets 400 and Ken gets 200. John gets 400 and Ken gets 200. It's an expense. It's a reduction of the partner's claim against the firm. So we debit the partner's current account. Interest on drawings is what the firm charges the partners. It reduces the claim of the partners against the firm with interest on drawings. So we debit it. Then we get interest on capital. Interest on capital, we add. Interest on capital, we add 1,800. 2,400, 1,800. Then we have salaries. We have salaries account, which is 24 for John. For John gets 24, but Ken gets nothing. Then you get profit share. We get profit share, and John gets 6,100. John gets 6,100, and Ken gets 6,100. Then we subtract drawings. We debited to the drawings. We debited to the drawings, and we have cash drawings. Which John is 4 and 2, 4,000, and Ken is 2,000 from the trial balance. But additional information number 6 gives us inventory drawings. And John gets 24 and 16, 2,400, and Ken gets 1,600. Those are the drawings. So we work on them to get the partners. We work on them to get the partner's current account balance. If we look at John, we add for John. This is 10,400 plus 24 plus 61, 2,400 plus 6,100. We get a figure of 18,900. We get 18,900. Now 18,900, if you subtract the debits, minus 400, minus 6,400. 4,000 plus 2, 6,400. We get 12,100. So our balance carried down for John is 12,100. Our balance carried down for John is 12,100. We get the balance for Ken, 6 plus 1,800, that is 7,800, plus 6,100, we get 13,900. 13,900 minus 2 plus 2 is 2, minus 2,200, minus 1,600, we get a figure of 10,100. So the partner's current account balance for John is 12,100, for Ken is 10,100. And because of space, as we prepare the balance sheet, this is the information which we will capture in the balance sheet. So I want to capture that information. Current account balances for John, we have said it is 12,100. And for Ken, it is 10,100. For Ken, it is 10,100. So we now prepare the balance sheet. We now prepare what?
Balance sheet.
We now prepare the balance sheet. And we say the only difference between the sole proprietorship balance sheet and that of the partners and the partnership balance sheet is that the partnership balance sheet does not have anything to do with the drawings. The drawings are captured in the partner's current account, and you just bring the current account and the partner's capital account into the balance sheet. You bring them into the balance sheet. So here we say, these people are called John and Ken. So we call it John and Ken partnership. We know why we have kept this one here. John and Ken partnership. Statement, we call it statement of financial what? Financial position. Financial what?
Position.
Financial position as at 31st of December 2018. Is it that 1st of December 2018? And we say assets. We start with assets, then we say non-current assets. Non-current what?
Assets.
Non-current assets. And then remember our format. Remember our what? Our format. We said land and building, plant and machinery, furniture, fixtures and fittings, and motor vehicles. So for this purpose, we start with freehold property at cost. Freehold property, which is not actually depreciated. Freehold property. Freehold property. So we say cost, provision for depreciation. Provision for depreciation, net book value. Net book value. Net book value. So our freehold property from the trial balance is 40,000. It is 40,000. 40,000. Sorry, we don't have depreciation. We get 40,000 as net book value. Then we go to motor vehicles. Motor vehicles. Motor vehicles. And then equipment. And then equipment. Then equipment. Now, motor vehicle, the original purchase cost for motor vehicle is 8,000. Equipment is 6,000. Equipment is 6,000. Equipment is 6,000. Now, our motor vehicle, original purchase, accumulated depreciation for motor vehicle is 2,000, and our charge for the year for depreciation for motor vehicles, our charge for the year for depreciation for motor vehicle is 2,000, giving us 4,000, giving us total expenses for motor vehicle 4,000, leaving us with the 4,000, So our charge for the year is 2,000. What had been charged as at the beginning of the year is 2,000. So our annual charge 2,000 plus what was there at the beginning 2,000, we get 4,000. Now, for the equipment at the beginning of the year, it was 1,200. It was 1,200, and this year is 960. 1,200 plus 960, we get 0611. 11 2. 2160. We get depreciation of 2160. We get the annual depreciation of what? 2160 is the annual depreciation. So if we were to get, we were to deduct 6,000, we subtract 2160, 6123 minus 2160, we get a figure of 3840. 3840. If you add all the three, you get 48,000, 123 plus 3840, you get a figure of 51. This 8,000 minus 4,000 is not 8,000. This should be 4,000. So 44,000, 123 plus 123 plus 3840, we get 47,840. We get 47,840. We get 47,840, and we say that is the total non-current assets. Total non-current assets. Please remember here the subtitle is only the opening letter that is in capital. Total T capital, non N capital, current C capital, assets A. The rest are small letters. Then you come to current assets. And from our format, we always know that the opening current assets is always the inventory. The beginning is inventory. And here we said it is 10,000. So we say inventory, additional information number 5. It is 10,000. It is 10,000. Then we know from our format. The next one is trade receivables. It is trade receivables or accounts receivables. Accounts receivables, which is 10,000. Our accounts receivable is 10,000. Our accounts receivable is 10,000. Accounts receivable is 10,000. Then we know we talk about prepayments and additional information number 2 tells us about prepaid carriage outwards. Prepaid carriage outwards. Prepaid carriage outwards amounting to 160. Amounting to 160. And then from there we go to bank. From there we go to bank and cash. There we go to bank and cash. And from our trial balance, our bank balance is 2,400. Our bank balance is 2,400. And I'm not seeing any cash. I'm not seeing any cash. So if we were to add them together, we get 20,160 plus 2,400. We get current assets amounting to 22,560. We get current assets amounting to 22,560. And these are total current assets. Total current assets. Now we add them up. We add the current assets with non-current assets to get total assets. We get total what?
Assets.
Total assets. Total assets. 47,840. 47,840. If you add 22,560, 22,560, you get 7,400. You get 7,400. There we see financed by. And we say capital and liability. Capital and liability. Capital and liability. Capital and liabilities. Capital and liabilities. And we start with capital. Go to the capital account to the trial balance and get the balances. John Ken, 2418. John, 24,000. Ken, 18,000. We get 000, 8 plus 2, 12, 42,000. 42,000. Current account. It is John and who?
Okay.
And we said we kept them here. John 12,100, 12,100, and Ken 10,100. Please see where I am adding them. For the capital, I'm adding them there at the end, but this ones I'm adding them inside and bringing the total there. So this becomes 22,200. 22,200. 22,200. 22 what?
200.
22,200. If you were to add all of them, 42 plus 42, 1,000, 1, 2, 3, plus 22,200, you get a figure of 64,200. You get a figure of 64 what?
200.
64,200. 64,200. Then we talk about current what? We don't have non-current liabilities, so we go straight to current liabilities. And we look for them at the trial balance. We have accounts payable amounting to 6,000. 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 And then additional information number 1. Salaries and wages outstanding were 200,000. Salaries and wages payable. Salaries and wages payable amounting to 200. 200, you get 6,200. Now, capital plus current liabilities, 64,200 plus 64,200 plus 6,200, you get what? You get 64,200 plus 6,200, get a figure of 7,400. 7,400. Capital and liabilities. Capital and liabilities. Now you can see the capital and liabilities of 7,400 is equal to total assets, 70,400. Assets equals to capital and the liability. The accounting equation. The accounting what? Equation. Total assets is equal to capital and liability. Thank you very, very, very much. I want to remind you again, please, 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 join us. Train with the best. We offer the best. We are very passionate and very committed to ensure that we do not have a student who is not passing. Thank you very much. See you.